Greetings, everyone. Welcome to the second module of our training, Introduction to Futures Contract. In our first module, we covered these topics. We talked about basics of the futures contract, what are the standardized elements in a future contract, what is the difference between a forward and a futures contract, and what is a payoff profile for people who are holding long position or short position in the futures contract. So let's move on. So our first topic for this module is mark-to-market process. So at the end of each trading day, the margin account is adjusted. You need to understand, first of all, what is a margin account. As I mentioned in module 1, that counterparty for all the traders in a futures market will be the stock exchange. It's rather clearing house of the stock exchange. Okay. Now, how they will make sure that there is no default by any trader? So what they do is they request their clearing members to ask their clients, which are the traders, to open a margin account. Okay. So this margin account is adjusted on a daily basis to reflect the investor's gain or loss on that particular day for this particular contract. This practice is what we call as daily settlement or mark to market. This is done to ensure that there are no defaults by the counterparties, because stock exchange is somewhere promising that if you win, you will get your money. So let's take an examples. Let's take one example to clear this mark to market process. Let's say there is a person named Ahmed. He is taking a long position in gold futures. That means he's a buyer. On the other side of the trade is Myra, who has taken a short position in the same contract. She is a seller. And the contract size determined by the exchange is 100 ounces is equal to one futures contract. Okay. Now the spot futures price of gold is $500 per ounce. So if you see, the contract value actually comes out to be $50,000. But what exchange is saying, that please put an initial margin of $3,000 only. And by putting $3,000 in the account, both of them can take a position on 100 ounces of gold. Okay. Exchange has also given a maintenance margin of 2,000. Just assume this as what we have like minimum balance in our accounts in the bank. For example, your savings account has a minimum balance. Assume this is the same. Okay. Now, uh, on day zero, the future price was $500 per ounce, and from here the game will start. So on the first day, end of the day, the price of gold went down to 494. That means it went down $6. Now we are talking about mark to market position for Ahmed, who was a buyer in this contract. Now to keep it simple, whenever prices go up, buyer makes a profit. Whenever prices go down, buyer makes a loss. As simple as that. And exactly vice versa for your seller. Okay. So in this case, on day one, the prices went down. Now multiply this price with your contract size, which was 100 ounce. So actually, Ahmed lost $600 at the end of day one. So his cumulative loss, since this was day one, there was nothing from before. So his loss is $600. So from his account, which he started with 3,000 initial margin, 600 will be reduced, and his new balance is $2,400. At the end of day two, gold went up by $1, right? Multiply this with your contract size, which is 100 ounces. So Ahmed made a profit of $100. So now his cumulative loss of 600 is reduced by this $100 of profit. So now his account stands at $2,500. On day three, gold went down by $7. Multiply this with the contract price, $700 loss, right? Now add this $700 into the earlier cumulative loss of 500. So his total loss is 1200. So from $3,000, he has lost $1,200. So his account stands at $1,800. But the exchange has given a maintenance margin of 2000. That means at this point, Ahmed will get a margin call. Now he has to refill his account and he has to bring it back to the initial margin level. So he has to put $1,200. Ahmed has put $1,200. Next day, gold went up by $2 multiplied by contract size of 100 ounces. He made a profit of 200. This will reduce his cumulative loss, and his actual balance, which was 3000, now has increased by 200. And similarly, for the remaining number of days, this process will keep on going. So this is your mark to market process. So marking to market is done to ensure that there are no default by the parties. Is it true? The answer is yes. This is done to make sure that everyone gets paid, right? Wherever the due is due, this person will get paid. So the clearing house and its members are very important for this whole cycle to work. A clearing house acts as an intermediary, as a middleman in all the futures transactions. It also guarantees the performance of the parties. That is why we are doing mark to market. The clearing house has a number of members. The main task of a clearing house is to keep track of all the transactions that are taking place in a day so that it can calculate the net position of each of its members. For example, there is a broker A, and for this broker A, there are two clients. Let's call them B and C. B purchased 10 lots or 10 contracts of a future on company C, whereas C on the other side, he sold 5 contracts on the same company C. So what is the net position of this broker A? This will be calculated by the clearing house. One of his client has purchased 10 contracts. Another client has sold the 5 contracts of the same very company for the same maturity. So the net position for broker A is 5 long contracts, right? So now clearing house will require broker to pay margin money, initial margin money for the 5 contracts only. Even though broker is getting margins from both of his clients, he has to pay to the clearing house the margin only for the 5 contracts. And also there's one more benefit for a broker. They are not required to pay any maintenance margin or keep any maintenance margin with the clearing house. So that's your mark to market. This is our last topic for this training, hedging with futures. So what is a hedge? Hedge is a transaction which you are doing to try to reduce or eliminate your risk. You're not looking to make profit in this transaction. You are just trying to reduce the risk level in this particular transaction. So to hedge a risk, the objective is usually to take a position that neutralizes the risk. Now consider a company that knows that it will gain $10,000 for each 1 cent increase in the price of the commodity, and will lose $10,000 if the commodity price goes down by 1 cent. Okay. Now, please understand that this company is already making a profit on this particular commodity. What they do not want is extra risk, right? Here is the extra profit and here is the extra loss. They are ready to sacrifice this extra profit, but they do not want this extra loss. So they are happy with the profit they are already making on this commodity. So the company's treasurer should take a short futures position. Why a short future position? Because if commodity price goes up, that is not the risk for the company. The risk is if commodity price goes down. So if you have a short position, right, that means you are a seller. That means you will make profit if prices go down and you will make a loss if prices go up. So the future position should lead to a loss of $10,000. Okay. If the prices go up, But if the prices go down, right, this company was supposed to lose $10,000. But since they have shorted futures on this contract, what is going to happen now is if the commodity prices go up, right, this company will make a profit. Let's say it went up by 2 cents. So they will make a profit of $20,000 on their actual position, actual commodity. But since they have shorted the future, this will give them a loss of $20,000. Because as I mentioned before, if prices go up, seller makes a loss. So this is gone. But at the same time, if prices went down by, let's say, 5 cents, in the actual position that this company will lose $50,000, but in the futures position, they will make a profit of $50,000, right? Because if prices go down, sellers make a profit. So this is what we call as hedging. So they are ready to forego the upside, but they do not want any downside. Okay. So a short hedge involves a short position in the futures contract, as I showed in the example. This short hedge is appropriate when the hedger already owns an asset. Okay, you need to own an asset and you are expecting that probably prices will go down in future. So rather than selling the asset right now, maybe you are an investor, maybe you want to hold it for another 5 years, but in the coming 3 months, your analysis is telling you it might go down. So take a short position in the futures market. All right. Long hedge is a position where you are taking a long position in a futures contract. So this is appropriate when a company knows that it is going to purchase a certain asset in future and they are worried that in future the asset price might go up. So it makes more sense to buy the futures of this particular asset. For example, there is a copper fabricator and he knows that he is going to require 100,000 pounds of copper in future. Now, currently, copper is trading at 340 cents per pound. He doesn't want to buy this copper today. He wants to buy it in future. So he will look the futures price of May delivery, which is trading at 320 cents. Now, it is very much possible that in future, the copper price might go up to 400 cents per pound, right? So this fabricator is worried about that. So what he is going to do? He's going to take a long position in this futures contract. As soon as he has done it, what is the ultimate result of this transaction? He has locked in the price of the required copper, right? By purchasing the futures, he has locked the price for himself. Now, if even if copper goes up to 400 pounds cents per pound, in the actual market, yes, he has to pay 400 pounds to purchase 1 pound or 400 cents to purchase 1 pound of copper. But guess what? Here, he is going to make profit of 80 cents in the futures position. So this is going to reduce his overall cost. Still, he is actually paying 320 cents. So this is your long hedge. So in summary, mark to market is done to ensure that there are no defaults by the parties. If a trader's margin account goes below a maintenance margin amount, he or she will get a margin call. Futures can be used to hedge both existing or forthcoming, as in positions which are going to happen in future. So for the current position and for your future position, in both the condition, you can hedge your positions by using the futures contract. I hope you learned something from this training and thank you so much for attending this. I hope you will look at our other offerings as well and feel free to enjoy other trainings. Thank you so much.